Hey investors, welcome back to another episode of Vishal Vealth View. Q4 earnings season has started, and I think this might be the most bizarre earnings season I have seen as an investor in last 4 or 5 years. The reason is there's a trade war going on between US and China, the two economic superpowers of our planet, and there's no sign of pulling it down. However, there is a rhetoric coming out from White House that, hey China, let's do a deal. Will not impose 245% tariffs on you, and final tariffs will be far lesser. But as of now, I have de-risked my entire portfolio from US investment. I have been selling these investment and moving that money to India Defense CTF, and I'll keep on doing so. I'm not planning to move back into US equities until unless I see policy certainty or a major correction in indexes like S&P 500 and Nasdaq 100. Also, there is a sad news that's coming in from Kashmir. 2 days ago, there was a terrorist attack in which 27 civilians were killed. India has not retaliated kinetically as of now on this matter, but I do expect in future there is going to be a policy change that might impact some of the industries. So we'll be keeping an eye out on the situation, how it unfolds, and how do we need to make changes in our portfolio for that. After Q4 results were announced, some stocks saw a massive rally. Anant Raj was almost up by 10% after the results were announced. So in today's episode, we're going to analyze results for Anant Raj, Tips Music, HDFC Bank, and HUL, and see do we need to make any changes on these companies or not. Before we start the episode, investors, if you like the content that I'm creating, do hit the like button because it helps promote this content to other viewers and subscribe to this channel. So first, let's start with Tips Music. Before I jump into the details, let me give you an overview. Tips Music is a music label company. Music label company का business model ये होता है कि they purchase music or they produce music and they own the royalty or the ownership of the music with the writer and the singer of the music for 50 to 100 years. And this is a really profitable business because you are only using your knowledge of understanding which music is good to purchase that music, and you'll get money from all these streaming platforms over time for next 50 years, 100 years. So that's the general business model of Tips Music, Saregama, T Series. Now, if we take a look at the numbers, it is a billion-dollar company, almost 8,300 crore market cap with a PE of 50. Now, majority of music label companies like Warner Bros. Music, Universal Music, they trade at a PE more than 30, 35 up to 50. So it is trading at a higher valuation or on the premium valuation with respect to the music label companies of the world. It is sitting on almost negligible debt, which is a good sign because you don't need huge amount of debt to acquire this music. You should be able to complete the cycle of purchasing new music using your profits. And that's what they are doing. The PEG ratio stands at 0.70, which says that it's a company that is able to generate better growth with respect to the price at which it's trading right now. The company has high ROE and high ROC number, almost 112%, which is a good sign. That means whatever capital they invest in their business, they are able to generate return out of it in a really efficient way. Let's take a look at March 2025 results now. So quarterly, if we take a look at quarterly, the sales did not increase with respect to last quarter, but there was almost a 30% jump with respect to the same quarter last year, which is March 2024. Now, this might be because of the cyclicality of the business. If you see December, March quarter, usually the sales is relatively same. But if we take a look at year on year, we saw a jump in sales of almost 30%, and so did profit. It jumped by almost 30% or more than 30% from 9.90 to 13.30, which is earning per share. So if we take a look at balance sheet, I think this is one of the healthiest balance sheet that's like available in the market because they are not diluting their equity. They are actually in the process of buying back shares. And that means the company and its owner and the promoters believe the long-term growth of the company, and it's able to generate more cash flow to them than just keeping this entire equity in the public market. The company has decent reserves with no borrowings. And if we take a look at the fixed asset purchase of the company has not been high over last uh, 5-10 years, because a company like this does not need a huge amount of fixed asset, and whatever that is getting spent over here, I would consider it as like mysterious money that's getting wasted, to be honest, and something to be audited properly, because owners might be using it for their personal luxuries. If we take a look at cash flow statement, which is where is the money coming in and where is the money going out, the entire profit from operation that the company is generating is going into purchasing new music and uh, buying new music labels. So if you see the from operation stands at 210 crore for year 2024-2025, and most of the money that this money is getting spent in purchasing investment, uh, and some amount of money has also been received by selling these investment or some of these songs to some other music label companies. They have not raised any capital from either the debt market or the public market, so no proceeds from borrowings and no proceeds from shares. Apart from that, the company has been paying dividend consistently of about 80 crores, and I think this will also increase as the sales of the company increase. The company is on a healthy growth trajectory for last 3-4 years, and let's see how this cyclicality how long this cyclicality will last. Considering the growing demographics of the country, I have a strong conviction on this country, on this company. Another interesting fact to note here is that the promoters have increased their holdings with respect to December 2023, and FIS have also increased their holdings in last quarter. So after the crash or after the correction in this particular company, FIIs have been a major buyers, and they are coming in from a long-term view. That's how I feel, because it's a consumption play and it's a high ROC consumption play. So this is a slide that is present in the result that's announced by Tips Music. It talks about what's the volume of music that Indians are consuming and what's the revenue that music label companies around the world versus India is generating. So if you see, with respect to the world, we are only 15% with respect to the streaming volume, and we are only 2% with respect to the revenues that the music label companies generate. So clearly, the room for top line growth is really high, and which is seen in the sales of this company as well, which is growing at almost 30%. So I am holding this investment as of now in my portfolio, and I am planning to increase this investment up to 4 lakh when the time's right, when the stock is fairly more depressed. Now let's talk about Anant Raj. Now I'm an investor in this company. I invested in this company almost 6-7 months ago because I was interested in the data center story of this company, and right now I'm sitting on a loss of almost 30%. So, before we jump into the result, let me give you an overview what this company is about. This company is a real estate company. They have commercial tech parks. They have commercial office spaces. They build commercial housing projects, and they are also venturing into data center business. That means they want to build up data centers on the land they already own, and they want to provide it as a software as a service. Now, if you see the fundamentals of the company, it's a $2 billion company with a PE of almost 40. The ROE, ROC numbers does not look good for the company. The PEG ratio is 0.51, and price to free cash flow is also looking negative. So let's take a look at the recent results. If you see the sales, it grew marginally with respect to the last quarter. With respect to the same quarter previous year, the sales have grown by almost 30%, and same is the case with the earning per share. Now, if we take a look at yearly results, there is a clear growth in yearly sales from March 2024 to March 2025. Now, this sales is a combination of both increase in housing projects being sold, commercial projects being sold, income from like rental properties. Also, the amount of money they are or the new capital they are getting from the data centers that they have set up. But if we take a overall look at the health of the company, the sales is growing at around 30 to 40% in past 3 4 years, and the profit is growing at almost 50 60%, and that's where the stock has been running as well. Now, balance sheet wise, the company is sitting on a healthy reserve. They do not have huge debt. Most of the debt that they own are long term borrowings. They are not even short term borrowings. Now, interesting thing to note here is the shareholding pattern, how it changed in last 1 quarter. The owner of the company actually purchased a big block in this company, and their stake has gone up from 60.01 to 60.16%. Now you have to remember the company came up with a QIP 4 5 months ago, where the company's owner invested almost 100 crore at a price of 701 rupees per share. And recently, after the stock corrected, after this entire trade war started, uh, Ashok Sarin, who is the CEO of the company, has increased his stake from 0 to almost 0.40. So clearly, promoter holdings have increased. FIIs have been a net seller, and DIIs have also been a net seller because this company was clearly trading on a higher value zone. This graph here shows the land reserve that they have across the country that they are going to use for future growth. So this company almost have 85 acre of land across West Bengal, North Delhi, and South Bihati. Now, some of them can be used for residential projects, some of them can be used for data center business, but this is the land bank that the company has right now. So let's take a look at what happened in India's data center story. So last year, India's total data center capacity stood around 1 gigawatt, and it grew by almost 24% CAGR over last 2 to 3 years. Now you have to understand this is the entire demand growth. This is not just growth of sales of one particular company, and this is going to reach almost 2 gigawatt or 1.8 gigawatt by 2027. And as per this demand, increase in this demand, Anant Raj is also planning to increase their capacity, and that's why they have plans in place. As of now, they are starting or working on three data center tech park projects. One is 50 megawatt, second is 57 megawatt, third is 200 megawatt. This is not started. The 57 megawatt one, they're planning to start the 7 megawatt capacity by Q1 2026, and in the Manasa one, they're planning to start 15 megawatt by Q1 2026. So let's see how these plans turn out to be, and based on that, I'll be increasing my investment or decreasing my investment in this company. If we take a look at the data center services that is being provided by them, so since 2019, they were only focusing on co-location services, which is when they provide you data center in a plain old box, and they do not provide all the associated services on top of it, like storage, like compute, and you have to manage all of this on your own. Now they're providing cloud service, which is infrastructure as a service, and this is to some extent, let's say not a copy, a competition of AWS or someone like GCP. Now we have to see how much it gets adopted. It's mostly going to be adoption in B2B space, not in B2C space. But this can increase their margins like dramatically for the same data center capacity that they have. So let's see how this plays out. But it's always a risky investment to like invest in a company that's venturing into new spaces. Next in line is HUL. Now HUL produces perishable consumer good that you and I as a middle class consume, and our lives depend on them. And they produce product that we don't even think twice before purchasing. So this company mostly caters to the middle class section of India. And in the recent times, since RBI has cut rates, government has decreased taxes for middle class. I do expect sales for HUL bouncing back. And they have also invested in acquiring new companies in past few years, which can turn out to be a good revenue generator for them in the coming years. So let's see what are the results of Q4 for HUL. So from a quarterly sales point of view, the line has been pretty flat. There is no significant increase in sales year on year or quarter on quarter. The sales currently is growing at 2 to 3%, which is not something that investors would like to see. But this is a stable company. It's a positive cash flow generating company. That's why it demands such a high valuation, and that's why it's trading at such a high valuation. Now, if we see in like year by year, what's the profit and loss? There is not huge increase in top line uh, across 2024 and 2025. Moving forward, there might be a possibility that this top line might grow more than 2% because people will have more money to spend in their pocket. Now, interesting thing to look over here is the cash flow statement for a company like this, because majority of the profits that they're generating uh, from their operations are usually getting funneled in purchasing new companies and purchasing new investment that can generate future cash flow for the company. So these companies are the one that can compound your money in an amazing way over a long period of time. Now, this is an interesting slide in the results. They are having an ambition to grow their EPS by almost double digit, which is more than 10% by growing their top line. That means they want to increase their sales by at least 10%, and that's how the EPS should be growing, maintaining their margins same. Now, this is a really ambitious goal. Let's see, like, do they have any plan for that in the slides? So the plan that they are thinking is they're going to move their core business to future core and market makers, in which they're expecting more margins and better top line. And that's the strategy that they are thinking is going to work the best across the board. So from a financial point of view, in the coming year, they're not predicting like double-digit growth. They're expecting low single-digit growth, even if the commodities prices remain stable. Now, based on the entire trade war scenario, how much the turmoil is going around the world, I do fear commodity prices can be pretty volatile, and I cannot predict them. But the market for this company is always going to remain stable because the consumers are usually middle class who have a good amount of savings, who will not think twice before buying these products. Next thing to note here is the sales and the margins of this company. For almost 2 years, the sales look pretty much flat and they're able to maintain healthy margins. And the reason is, even though the commodity prices fluctuate, they can pass on the increase in prices directly to the consumer because they hold that pricing power. And the question is, from here on, can the sales increase? And if they're able to increase the sales, the company will generate more cash flows. Uh, I don't know the answer to that. I would like to see at least one more quarter to see if there are any signs, early signs of people spending more money in the products they have and their plan actually coming to life. And on the basis of that, I'll probably invest money or take that decision. Now, next company in line is HDFC Bank. This is the biggest bank in India, but it's also a company that's really hard for me to understand because bank's balance sheet has loans, and I cannot comprehend how risky those loans are. So I'll take it on face value. For the latest quarter, there has been increase in revenue, and the EPS also saw a jump. But over past 2 3 years, the EPS has been flat, and there has been no significant growth in the company's profit. So, like, even though it's a good company, you might not make money if you buy it at a wrong price. So that's the decision that investors have to take. For me personally, I use it as a place to park my money or to have some amount of liquidity because HDFC Bank is a really like big company and it does not fluctuate more than 10 20% in a single day. So it's handy for me to maintain or get cash whenever I need and invest in some other place. But if we take a look at the face value, the company is trading at a PE of 20, and the company has a healthy profit and growth trajectory. So I would not hesitate uh, putting my money in this company slowly because there might be a good chance that there is a rally coming in banking sector after the interest rates are cut down and people will start spending more and people will start borrowing more. So let's see how this turns out. That's it for today's episode, investors. If you enjoyed this video, do hit the like button because it helps reach this video to more user and support my work, and subscribe to this channel. Bye bye.